Unilever Nigeria last Friday published its half-year earnings, posting 5 billion naira profit before tax. That's a 239% increase year-on-year. Now, the company's revenue also grew 40%. Now, analysts at Exotics Capital call this another strong quarter. Now, let's bring in an equity analyst at Exotics Capital, Olabisi Ayodeji, to tell us more on this earnings. Good afternoon, Olabisi. Thank you very much for joining us.
Actually, thanks for having me.
Now, in your report on Unilever, in your view, it's a strong quarter. Were you surprised with that, with what you saw?
Well, yeah, the results were better than we expected. The home and personal care segment, for example, showed particularly strong top-line growth during the quarter. Although I should also say that the improvement that we've seen in year-on-year profit is because of the weak base effect in the same period last year. Essentially, last year there were issues such as a significant increase in input costs, as well as a weak volume in some of the home care brands. So now that price increases have been implemented, we've seen that this has contributed to the stronger earnings that we've seen in the quarter.
Now, aside from the home and personal care areas that you talked about, what are the factors or areas do you think drove the company's performance, and have you noted any challenges that the company faced during the quarter?
Okay, so like I mentioned before, there have been a series of price increases over the past 12 months. These have helped to offset some of the high input costs that the business has had to face given what happened with the Naira. Additionally, like I mentioned, there's also been some volume growth, and this comes off of the back of first weak competition in Nigeria, given that a lot of the smaller players have essentially caved under the pressure of the tough operating environment. And then secondly, we believe that there's been an increase in cross-border trading. And these two factors have helped to contribute to volume growth for the business. Additionally, Unilever has implemented a number of cost-cutting initiatives. All of these factors have contributed to the recovery in earnings that we've seen since Q3 2016. And it also contributed to the strong earnings growth that we saw in Q2 17. Now, on the negative side, input costs were also an issue in this quarter. And then also there was a significant increase in interest expenses, given that first, the company now has a higher debt balance, and then we're generally in a higher interest rate environment now. So these were the challenges that the company faced in the quarter, but they were more than outweighed by the positives I mentioned before.
Now, the company's net operating cash flow was weaker, in quarter two. What do you think was responsible for that?
Yeah, well, despite the higher operating profits, the company had the higher working capital requirements, right? If you look at the financial statements released, you see that there was quite an increase in prepayments and inventory, and we believe that this represents some form of hedging that the company decided to implement to protect its operations against further increases in input costs, as well as movements in the exchange rates. So these two factors more than outweighed an increase in trade payables in the quarter, and that's why net operating cash flow was weaker in Q2 17.
Okay, Unilever is now embarking on rights issues. Can you shed some light on the purpose of this and possibly the impact on the business going forward?
So Unilever is, like you mentioned, embarking on a rights issue. The amount to be raised is 58.9 billion naira, and the plan is to use the proceeds from this to offset its FX liabilities. We would measure this balance to be at about 43 billion naira as of the end of the first half of the year. Other than this, the company has also announced that it would like to use the balance of the rights issue to essentially fund working capital for the next couple of quarters. Our view is that it's a positive in the sense that there's a bit of a positive to it in the sense that it helps to reduce the potential risks of the company having to recognize FX losses in the event that the Naira weakens further, given its significant FX liability position. But on the negative end, based on what we've seen in the financial statements and the fact that the business continues to have stronger or relatively strong cash generating capacity, we believe that there will be a significant cash balance retained in the balance sheets. Management might have a plan for this balance, just hasn't been disclosed yet. But essentially what we think is that given the increase in equity that will not be accompanied by a commensurate increase in earnings, there's going to be a bit of a decline in ROEs, and that's our concern regarding the rights issue.
Okay, Olabisi, just a quick one before I let you go. In your investment conclusion, you are recommending a sale. Why?
Well, for a number of reasons. First, the business remains very reliant on imported raw materials and finished products. And then secondly, like I mentioned before, we expect that ROEs will weaken further following the completion of the rights issue. And then lastly, we think Unilever's valuations are relatively rich relative to compared to other local consumer companies. And given its reliance on imported raw materials and products and its earnings history, we think the valuations are demanding, which is essentially why we think would recommend a sell on the stock at this time. Okay.
Thank you very much for your time, Olabisi. Olabisi Ayodeji is an equity analyst at Exotics Capital. And that's a wrap on today's edition of the program. Thank you very much for watching. I'm Chimeze Obi. You're welcome.